Good evening, ladies and gentlemen. Welcome to this session. Very sorry to disrupt your Friday. Uh, I think you know that the time that we are in, uh, if we miss any class, it wouldn't make sense as for us not to cover for it. That's why I had to inconvenience you. All right. Today we're going to deal with impairment of assets. All right. Impairment of assets, as you will see, that I will not do much for now. Why? Because impairment of assets normally is not a standalone topic. Normally, for you to understand impairment of assets, you do it within the scope of other topics. So you will see that today I will mainly talk about the theoretical background of it. But we're going to do much on impairment of assets when I do the next topic on intangible assets, and when I do the non-current assets here for sale. And also, I think if you still remember, I also talked about it when we did property, plant and equipment. So it's no it's a separate topic, but its application is within other topics. So today I will give you the background of the impairment of assets, but then we're going to do more on Tuesday when we deal with intangible assets, and also probably during the weekend when we deal with the non-current assets sold for sale. I think am reminding you again that next week we're likely to have two classes, one on our normal Tuesday and another one during the weekend. Right. Because we want to make sure that we try to cover a, intangible assets, non-current assets held for sale, and impairment of assets over the next week. Right. So I've sent a document. So we're going to discuss this document. This document I've already sent to you, so you already have it. So don't worry much about it because you already have it. So we're just going to discuss together the impairment of assets. Right. An asset is considered impaired when its carrying amount is now more than its recoverable amount. When its carrying amount is now more than the recoverable amount, then we say an asset is impaired. For example, if we know that our asset, the carrying amount in our books is 100,000, but then we know that to sell it, we can only get 90,000. It doesn't make sense for us to continue recording it at 100,000. It would be better that we reduce it to its worth, which is 90,000. So that's when we say there is impairment. Is that right? But as you shall see, it's not just as simple as I've said. So we're going to look at the concepts that define impairment. Right? Impairment will occur when our carrying amount, the carrying amount of the asset is more than or exceeds the recoverable amount. So please, you should know that there is impairment if the carrying amount is more than the recoverable amount. So what does that mean? For us to determine impairment, we should have two things. We should know the carrying amount and we should know the recoverable amount. Right. And we are going to learn that a recoverable amount can be defined, it can be determined by two different figures. Right. And if there's an impairment loss, this impairment can be reversed in future. For example, you might have assets, they can drop their value on the market, resulting in a fair value which is far less than the carrying amount. But they can be, by the end of next year when we do our books, there can be changes on the market again, which increases the fair value of the asset. So in that case, if we had recognized the payment in the previous year, we can also reverse it if there are signs and there are indicators that show that whatever factors for which we had impaired an asset in the past, they no longer exist. So any impairment recognized can be reversed in future when circumstances change. Right. I think you shall see that at a later stage. So an entity is required at the end of each year to assess whether there is an impairment or not. So they should assess, they should do what we call a test of impairment, right? Then if there is an indication of impairment, then they should determine the recoverable amount to check if that recoverable amount is now less than the carrying amount, so that we can measure impairment. But on the other hand, when there is no indication, there are no factors that can point to possible impairment, there is no need for you to estimate the recoverable amount. So according to the standard, to IAS36, you only have to measure the recoverable amount if there are indications that your assets might have been impaired. If there are no indications, then there is no need for us to test for, to calculate the recoverable amount to check if there is any impairment. So the test is mainly important if there is an indication of an impairment loss. And we're going to talk about indicators. What are the indicators that show that there can be impairment? Right. Right. But we've got circumstances whereby there is forced a test of impairment. Right. So whether there is an indication of impairment or not, an entity shall test an intangible asset with an indefinite useful life, not yet available for use for impairment. So if you have got an intangible asset which is not yet available for use, you are forced by IAS36 and IAS38 to test that intangible asset for possible impairment every year, regardless of whether there are indications or not. Then there's also goodwill. When you acquire a business, you might pay also for goodwill. Goodwill is when you pay more than the net assets. You'll be paying for things like skilled management, good location, and stuff like that. Right. So if you acquire an entity and there is a payment for goodwill, that goodwill has to be annually tested for impairment. So under these circumstances, you are forced. That means regardless of whether there are indicators or not, you are required to test for impairment. Right. But for other assets, remember we said the measurement of the recoverable amount will only be necessary if there are indicators of impairment for other assets. But for this one that we're talking about, that means annually you are required to test for impairment. Right. Now, let's look at the indicators. When we say indicators of impairment, what are those things that may point that there is possible impairment of an asset? Right. We can get these indicators from various sources. We can get from external sources of information. We can get from internal sources of information, or from internal reporting. There can be things that can point that there can be possible impairment of our assets. Right. What are the external sources of information that we can get? Right. If during a period the market value of an asset has declined significantly, I think we see that happens with computers. They are continuously developing computers, even with vehicles. You would find that when a new model is come on, the older models usually fall in price. You see it happening with phones. There was a time where that old BlackBerry was the thing in town. But as they develop better and better technology, you would find that the older assets become outdated. So if we see that the asset that we have, the price on the market is significantly gone down, it might be a possibility that that asset is impaired. So we have to test for impairment. Right. Significant changes with an adverse effect on the entity have taken place during the period. Let's say, for example, the machine that we are using is highly pollutive. it pollutes the environment. Then there is new legislation that limits the carbon emissions that can be allowed from machines. And the limits that have been placed are above what that machine can produce. So that can be a possibility of, there can be a possibility of impairment there. Right. There can be a movement in market interest rates and market rates of return. They can impact the value of assets because they will affect what we call the discount rate that can be used to determine the value in use. I think we are going to learn that when you use the value in use, we use the discount rate to discount the future cash flows. Now, if the interest rate goes up, the value in use will go down. So that can affect the impairment. Right. Carrying amount of net assets are more than its market capitalization. Like you see that the value of your shares on the exchange, let's say for example, they are 1 million, but your net assets are 1.5. That can be an indicator that your business assets are overvalued. All right. These factors, we're not saying that they indicate impairment. They are possible indicators of impairment. So they force you to test if there's impairment. All right. Evidence can also be obtained from internal sources. All right. There can be obsolescence or physical damage. Let's say your vehicle had an accident. That accident can also be a possible indicator of impairment because it might have lost value. Your depreciation method is 10%, which determines the carrying amount, but it had a terrible accident which significantly reduced its value. Right. So the physical state, or it can be, when we say obsolescence, like coming out of date. I think you know that they were typewriters. When the era of computers came, they became out of date, sort of. Right. Significant changes that have happened internally, which can render the asset to reduce value. For example, we've expanded to the extent that we now needed a heavier machinery, to the extent that these smaller machines are no longer compatible with our operations. That can affect the asset. Right. Evidence can also be there from internal reporting that the economic performance of the asset is worse than expected. For example, we're expecting the machine to produce 10,000 units a year. And then we find that it's now producing 7. Then it's now producing 6, 5. That can show that your machine might not be as effective as what you expected, which can be an indicator of possible impairment. Right. Then there can also be evidence from internal reporting. Right. Cash flows for acquiring the asset or subsequent cash needs for operating or maintaining it are significantly higher. You see that your vehicle, you used to spend a 600 rand towards maintenance, but the maintenance costs and the repairs every year, they are going up. We are now spending more on repairs. That can be a sign that the asset might be impaired. Right. Actual cash flows or operating profit or loss flowing from the asset are significantly worse than those budgeted. Right. Remember that at the beginning of the period, the entity will produce a budget. So you might find that the cash flows that you are generating from the usage of the asset are less than what you had budgeted, regardless of maybe working the same hours that you were expecting. You were expecting to work 8 hours a day and you are working the 8 hours a day. The demand is there, but you find that you can no longer produce as much as the cash flows that you are now generating are lesser. All right, a significant decline in budgeted net cash flows or operating profit, or a significant increase in budgeted loss. All right, if you see that when you do your budget from year to year and you see that your budgets are going down with the same assets without increasing the assets, there can be a possibility that your assets may be impaired. All right, there can also be operating losses or net cash outflows for the asset when you aggregate the current period with the budgeted figures for the future. So if you look at the cash flows for this period and the future, if you combine them and you find that they are likely to be net cash outflows from using the asset, that can be a possible indicator that your asset is overvalued. Because when we say it's impaired an asset, we are saying in our books, the asset is overvalued. The value at which we are recording the carrying amount is actually more than its actual value. So all these things will provide evidence that there is impairment. Right. So then, how do we determine impairment? How do we determine impairment? Right, when we are determining impairment, remember our rule. Let me maybe write it here so that we remember our rule. Right, there is impairment. There is impairment loss if the carrying amount is less than the recoverable amount. CA is carrying amount. RA is recoverable amount. So first of all, we have to determine your carrying amount. Your carrying amount is determined according to the standard for that particular asset. If it's property, plant, and equipment, you use IAS16. If it's a investment property, you use IAS40. If it's an intangible asset, you use IAS38. Then you determine the value of the asset. Those are just examples of the assets that I've talked about. There can be other standards also. For example, you can use those IFRS 9 for financial instruments and stuff like that. Right. So first of all, you have to determine your carrying amount and your recoverable amount. Right. As long as your carrying amount is less than the recoverable amount, then there is impairment. If the carrying amount is more, sorry, I think I made a mistake here. Sorry about that. I've made an error here. That's a disaster. As long as the carrying amount is more, sorry about that, is more than the recoverable amount, then there is impairment. If the carrying amount is less than the recoverable amount, you don't have to make adjustments. Then everything is okay. That means the carrying amount is okay. We only adjust if the carrying amount is more than the recoverable amount. Our impairment loss would then be your carrying amount minus recoverable amount. Right. Carrying amount, we know how to calculate it. For example, for PPE, it will be cost less accumulated depreciation. For an intangible asset, which we shall do on Tuesday, it will be cost less accumulated amortization. For a investment property, it can be cost less accumulated depreciation, or it can be the fair value. That will be the carrying amount. But what is the recoverable amount? All right, recoverable amount is the higher of fair value less cost to sell 1, fair value less cost to sell.
I'm sorry, Eugene, what does that mean? Fair value less cost to sell?
I'm not yet there. I'm just giving you the general formula. I'm going to come to that. Right. And the value in use, I'm going to deal with these things one by one. We're coming there. We're just on the introduction of that impairment. We're going to deal with the fair value less cost to sell and the value in use. Is that right? So I'm coming to that. Right. So for you to determine your recoverable amount, you need two things. Your fair value less cost to sell and the value in use. You determine those two figures, and the higher of the two is your recoverable amount. So you have to determine the two figures. The higher of the two will be the recoverable amount. Right. So now we want to come to C to check how we measure the fair value less cost to sell. What is that fair value less cost to sell? Like what my sister is asking, and what is value in use? That's what we're coming to. Right. So we're saying, first of all, compare your carrying amount to the recoverable amount. What is the recoverable amount? The higher of fair value less cost to sell and the value in use. Now we want to check what is the fair value less cost to sell. Right, fair value, we talked about it. Which we said, remember we're dealing with an asset. That is the value at which you can sell the asset in the principal market or the most advantageous market if there is no principal market. That's the fair value. Minus any costs that we have to incur to sell the asset. Let's say I've got a machine and the principal market is in Joburg. I stay in Pretoria. And for me to sell it in Joburg, I can sell it for 100,000. But for me to go with it to Joburg, I will spend 5,000. And there is a commission of 3,000 required for the seller. That means my total amount that I will incur, the cost that I will incur is the 5 plus 3, which is 8, for me to get the 100,000. So my fair value less cost to sell will be 100,000 minus the 8,000, which is the 92,000. So fair value less cost to sell is the fair value of the asset minus all the costs that we have to incur for you to sell the asset. That is fair value less cost to sell, which is the subject of this screen that I am showing you now. Right. If you see, how do we determine fair value less cost to sell? That's what we're talking about here. So fair value less cost to sell is determined by a binding sale agreement at an arm's length transaction. That is, if we have to sell this asset at an arm's length, whereby there are no related parties, we are not considering relationships. Let's say that I know this is our fellow company, so we can sell to it at a lesser price. When we are deciding based on market issues, right, then if the asset is traded in an active market, is the current market price less the cost of disposal. That means if there's a market of similar goods, which are we are not talking about new goods, we are talking about goods that are in a similar condition. So when you're looking at your fair value, you look at the fair value of the asset that is in a similar condition to yours. Remember, yours has been used before. Right. Then the fair value should be based on best available information of the most recent transactions. So we should not, when we are valuing around, let's say our year finished on 31 May, we should look for prices around that 31 May. The prices in the market around that date. right? So this should not be based on forced sale. For example, let's say expropriation by the government. It should be a sale that is done properly. Right. So are we okay on the fair value? Did I answer you, my sister?
Yes, I'm answered. Thank you very much.
Right. So that's what we mean when we say fair value less cost to sell. It's the selling price less any selling cost that you have to incur to sell that asset. Then value in use. Value in use. You now value the asset in terms of the economic benefits that you are likely to generate from using the asset. So you look at a machine, then you see, okay, what value are we going to generate from using the machine in the future? So you estimate the future cash flows that are likely to be generated by the asset. Then remember, these are cash flows in the future. Then you discount them using a discount factor. That's why we said earlier on, indicators of impairment can be the interest rates, because you have to find the discount rate that will be used to discount the future cash flows. So we have to estimate future cash flows that you expect to derive from the asset. That is the inflows minus the outflows. Right, and you have to take all possible variations like probabilities and stuff like that. Then the time value of money will be represented by the discount rate that we shall use. So if you are going to get 100,000 next year, remember that there's an opportunity cost. 100,000 next year is not equivalent to 100,000 today. So you have to discount those cash flows using the entity's pre-tax discount rate. I'm going to do that. You will see that using figures when I look at examples. Right. When you are estimating the value in use, you estimate the future cash inflows and outflows. Then apply the discount rate to find the present value of the cash flows. Right. So whatever you get as the present value, that will be your value in use. When we are saying value in use, that it means what is the value that we are going to gain by using the asset. Remember that you can recover the value of an asset in two ways. Either you can sell it and get your money back, or you can use the asset to generate economic benefits. Those are the two ways in which you can recover the value of an asset. So that's why the recoverable amount is determined by either the fair value less cost to sell, that means how much you can sell it, or the value in use, that is what is the value that can be generated by the entity by using the asset. So when you're calculating value in use, you estimate. So it's a question of estimation of the future cash flows that are likely to be generated by using the asset. Then you discount them using the discount rate of the entity. All right. Then how do we recognize in the financial statements? Impairment loss is an expense. Normally, we treat it as an expense. But if you are dealing with an asset that has been revalued, let's say, for example, land was revalued before, you will have to subtract the impairment from the revaluation. So it will then go to other comprehensive income. Remember, the revaluation goes to other comprehensive income. But if you are dealing with assets that have never been impaired, that had never been revalued upwards, an impairment loss is treated as an expense. So only if an asset was revalued before, that's when we treat it as a revaluation decrease. So you reduce the revaluation. But if we are dealing with assets that had never been revalued, a impairment loss is an expense in the statement of profit or loss. And accumulated impairment is a reverse asset. That means it is subtracted in the statement of financial position, just like accumulated depreciation. So impairment loss, just like depreciation, is an expense, and the accumulated impairment loss is subtracted from the asset in the statement of financial position. Right. So it's an expense. Then there can be reversal of an impairment. The factors, the indicators that were there in the past that could have indicated that there's possible impairment, they might be reversed in future. As I said, that maybe a cost of an asset on the market can significantly go down. Maybe there is a flooding of imported machines of the same that can by other companies that have suddenly started to supply to South Africa. Then the value of the machine will go down, so there will be impairment. But then maybe after the influx of the imports, the South African government can put laws that make it difficult now for such machines to be imported to protect the local industry. And when that happens, the price of the machine might start going up. When they go up again, that can cause you to reverse previously recognized impairment. Right. So if there's an indication that the previously recognized impairment no longer exists, you are required by the standard to carry out our test to check if indeed the impairment happened. Let me just give an example. Let's say this is 2021. You found that the carrying amount was 100,000 and the recoverable amount was 90,000. So it means there's an impairment loss of 10,000 since our carrying amount is more than the recoverable amount. Then now let's say at the end of 2022, we find that the carrying amount is now 80,000. All right, but the recoverable amount is now 85,000. So we have to reverse impairment loss by 5,000. Because the asset, yes, there's a change now. The recoverable amount is gone up. So out of that, but you can only reverse an impairment loss to the extent that it was recognized. For example, what do I mean here? Let me change this example. If the recoverable amount, let's say, for example, you find that in 2022, the recoverable amount is 95,000. If you can see, the difference here is 15,000. But we cannot reverse 15,000. We will only reverse 10,000, the impairment that was recognized here. So when you reverse, you can only reverse up to the maximum impairment loss that was recognized in the past period. So when you reverse impairment, you can only reverse up to the maximum impairment loss that was recognized in the previous period, not more than that. Because when you say you reverse, you can't reverse what you never did. You can only reverse what was done. So a reversal of impairment, you only reverse up to the maximum of the impairment loss that was previously recognized. Right. Indicators of reversal, they can also be external or internal sources. So you'd find that these indicators are just like the opposite of those ones that we're talking about. Right. The asset market value can go up. There can be changes that have got a positive impact. Market interest rates can go down. So it's the opposite of those other factors that I talked about. Internal sources, changes with a favorable effect. The performance has increased, maybe the productivity has gone up. So it's actually the opposite of those factors that indicate impairment. Right, how do you treat a reversal? A reversal, there are two ways that we can treat it. Either we can recognize it as income, or you can deduct it from expenses. But if it's for a revalued asset, it will go back to the revaluation and then we'll increase the revaluation again. For a revalued asset, we have to increase the revaluation. But if it's a non-revalued asset, we shall recognize it either as income or a reduction in an expense. Right. Then the disclosures that are required. That means when we say disclosures, my friends, that means accompanying the disclosures are those things that those notes that you have to give accompanying the financial statements. All right. If there is impairment, you should disclose in the notes the amount of the impairment loss and the line item where you recognize it. For example, if it's in other expenses, you have to state that it is in other expenses. Then if there is any reversal, you have to show the amount of the reversal and the line item that you reported it. For example, if you put it in income, you have to state that it was in income. If you reduce the expenses, you have to show that you reduced the expenses. Then the amount of impairment that went to other comprehensive income. Remember, it goes to other comprehensive income if we are dealing with a revalued asset. Right. So all these disclosures have to be made. So this is general information. You can read the other things from the standard or from your recommended text or notes to see the other things about the impairment of assets, but these are the major aspects that deal with impairment losses. Do you have any questions there? Right, so let me quickly illustrate how we deal with impairment. Right, so that you can see what I was saying. Right, I'm not going to deal with question one because question one deals with impairment of an intangible asset. I would like to deal with an intangible asset after doing the intangible assets on Tuesday. Right, so because on Tuesday I will do it. So as I said, the impairment is not going to end now. As we do intangible assets, we'll face impairment. When we do non-current assets, they will say we'll face impairment. So the type of number one, I will deal with it when I deal with the other topic. So I'll deal with question 2 and question 3. Right, Fashionista Limited is a clothing manufacturing company which supplies clothing to retail outlets all over South Africa. The company is a 31 December year end. The following details regarding the assets of the company are available. Right, we have the new knitting machine. Right, on 10 March 2016, management decided to expand its manufacturing activities to include the production of knitted garments. On 25 June 2016, a flatbed knitting machine was acquired for this purpose at a cost of 2,069,200 and paid in cash. The flatbed knitting machine was transported to Hammanskraal at a cost of 28,300 and was installed and tested at an additional cost of 18,400. Both the transport and installation costs were immediately settled in cash. Remember, transport and installation costs are direct costs of acquiring an asset. So they are included in the cost of the asset because they are considered direct costs of acquiring an asset. Right. Then we're told that the flatbed knitting machine was available for use as intended by management on 1 August 2016. Remember the date that the asset is available for use, that's the date that we start to provide for depreciation. On this date, management estimated the useful life of the flatbed knitting machine to be 5 years, and the residual value of 119,500 was allocated to it. Right. On 31 December 2016, it was determined that the actual output of this flatbed knitting machine did not meet the original estimates made. And the management of the company, by the management of company, already that's an indication of impairment. When an asset no longer meets the original estimates of productivity. Right. On this date, the fair value less cost to sell of the flatbed knitting machine was estimated with reference to current market evidence to be 1.2. That's the fair value less cost to sell. While the net cash inflows expected from the use of the machinery was determined to be 1,073,129. An applicable pre-tax discount rate of 8% per annum was applied. So that means that is the net cash flow after applying the discount rate. The remaining useful life of the flatbed knitting machine remained unchanged. Right. The question is, disclose the following notes to the annual financial statements of fashionista, property, plant, and equipment. All right. Impairment of assets. Right. Question 1. Okay, that's question 2. Extract of the notes to the financial statements of Fashionista Limited for the year ended 31 December 2016. Right, with machinery. Right. Carrying amount at the beginning of year. Cost accumulated depreciation. Just like our normal PPE, like what we're dealing with when we're doing property, plant, and equipment. Right. So if you check here, this asset was bought on 10 March. Right. On 25 June 2016. So it was acquired this year. So that means at the beginning of the year, we didn't have machinery in this particular case. So that would be 0. Is that right? Right. Then we have additions at cost. Right. Now, all our additions would include the total cost. That is the cost of acquiring the asset, transport, and installation. And please remember those costs that we're told that we should not include in the cost of the asset. Those things like operating losses, advertising, and stuff like that. We should always know that they are not supposed to be included. So I would say our cost would be 2069 200 plus 28,300 plus 18,400. What do we get? 2,115,900. Right. Then depreciation for the year. Right. According to the accounting policy of the company, machinery is accounted for using the cost model. Depreciation on machinery is accounted for in accordance with the straight line method over the estimated useful life of the asset. And we're told that here, the flatbed knitting machine was available for use as intended by management on 1 August. Remember, our year is ending in December. So our depreciation will only be for 5 months, August until December. Then on this date, management estimated the total useful life of the flat knitting machine to be 5 years. And the residual value of 119,500 was allocated. So our depreciation would be the cost, which is 2,115,900 minus the residual value 119,500 divided by the useful life, which is 5 years, multiplied by the number of months that it was available for use. It was available from August until December, so multiplied by 5 divided by 12. What do we get? $166,367. Right. Now, since there's a possible indication of impairment, we have to test for impairment. Right. So our carrying amount of this asset is 2,115,900 minus 166,367. What do we get? Thank you. 1,949,533. Thank you, guys. Right. Then our recoverable amount. Right. We have fair value less cost to sell, 1.2. Right. And our value in use, 1073129. Right. Therefore, recoverable amount How much will be our recoverable amount, my friends? $1.2. Thank you so much. Why? Higher. Thank you so much. So it is the higher of the two. So you have to find your fair value less cost to sell and your value in use. The recoverable amount will be the higher of the two. So the fair value less cost to sell at 1.2 is more than the value in use at 1073. So that means our recoverable amount is 1.2. Then your next stage is to compare your carrying amount to your recoverable amount. Your carrying amount of 1949 is more than the recoverable amount of 1.2. So we can say carrying amount $1,949,533 is greater than recoverable amount, which is 1,200,000. Hence, there is impairment. Right. Then our impairment loss would be equal to your carrying amount less your recoverable amount, which is 1,949,533 less 1.2. We get 749,533. So here would have impairment loss. So it goes in the PPE note. Right. Then we get our carrying amount at end of year. With our cost and our accumulated depreciation and the payment. And you are allowed to have a accumulated depreciation on its own. Then down here, you can put accumulated impairment on its own. Or you can combine them like what I've done. So it's 2,115,900. And our accumulated impairment would be the 166,367 plus 749,533. Right. So that is equal to this plus this. Then we get our carrying amount. So I didn't write the heading. Always you should write the heading. Right. The question does not ask us to do the impairment loss, but I can do it. Then you can write that an impairment loss of 749,533 was recognized on machinery What was the reason? They said that the actual output of the flatbed did not meet the original estimates. So due to the actual output of the flatbed knitting machine not meeting the original estimates. This impairment loss was recognized in the other expenses line item. In the profit or loss section of the statement of profit or loss and other comprehensive income. Is that right? So if it was a revalued asset, then you would have recognized it in the other comprehensive section, under comprehensive income section. So this is how we would disclose. When they say disclosed, that's what they mean when they say disclose the impairment loss. You only do the impairment loss if you are asked to do it. So I've just done it so that I can show you how to do it. Any questions? Right. Let me also show you the other calculation of the impairment loss. I will not do the full note. Let's see the question 3. Question 3. Right. The primary business of Barry Limited, a media company based in Cape Town, is to print, distribute, and sell newspapers. The company has a 30 April reporting date. Machinery. On 1 June 2013, the company acquired a bulk newspaper printing machine for 920,000. The machine had a useful life of 9 million newspapers and an estimated residual value of 250,000. The machine was available for use as intended by management on acquisition date. The machine printed 6,600,000 newspapers since acquisition until year end 30 April 2015. During the current financial year ended 30 April 2016, the machine printed 1.1 million newspapers. During the 2016 reporting period, Barry Limited's biggest competitor introduced the digital versions of their daily newspapers, which are more accessible to readers on a daily basis. So that's an indicator. That's what we're saying, that those are indicators of impairment. These new digitally available newspapers resulted in a decline in the demand and sales of Barry Limited's printed newspapers. So those are the internal reporting indicators. Subsequently, the fair value of the machine was estimated to be only 180,000 on 30 April 2016, and the legal fees relating to the possible sale of the machine was determined to be 8,000. So the fair value less cost to sell would be 180. The fair value minus the legal fees, which are 8,000, which are required to sell the machine, which is 172,000. The estimated future net cash inflows for the next 3 years relating to the machine are as follows. Right, the future cash flows, they help us to determine the value in use. Right, assume that all cash flows occur at the end of each financial year. All an acceptable pre-tax discount rate is 9.5% per annum. Right, so let's quickly look at this. Then it says machinery is accounted for in accordance with the cost model. Depreciation on machinery is in accordance with the units of production method. Right, then disclose the following notes to the annual financial statements. There's the property, plant, and equipment, and the deferred tax. I'll mainly deal with the property, plant, and equipment, then you do the deferred tax at your own time. I think I showed you how to do the deferred tax. it will not be different from what we did the other time. Right. So Jeff. Right, and also there can be implement of a what we call a cash generating unit. I will find an example that I will determine that is a group of assets. Right, so let me quickly do this one so that we can have time to rest. Right, so we can say, let me just quickly do it. Extract of the notes, the financial statements, of Barry Limited for the year ended 30 April 2016. Right. We have machinery, we have carrying amount at the end of the year, at the beginning of the year. We have costs. The cost we have it here. It was bought for 920,000. So it's say 920,000. Right. Then we have accumulated depreciation. They are using the units of production method. So it's say 920,000 minus the residual value. Remember, the residual value was 250. Yeah. Right. And okay, thank you. Let me just put it so that you, thank you, Juliet. Right. Property, plant, and equipment. Right. Our residual value is 250. Then the usage before the current year, there was 6.6 million newspapers up to 30 April 2015. Remember, when we calculate the accumulated depreciation at the beginning of the year, we use the usage. If we're using we're using the units of production, we use the production before the current year. And the useful life is, they said it's 9 million newspapers, I think. Yeah, 9 million. So say minus 250,000 multiplied by 6.6 million divided by 9 million. What do we get? $49,133. Thank you. But is that correct? It seems too small for me. Are you sure? I don't think that can be correct. Okay, there's another 3. Okay, thanks. Because it appeared too small for me. Right. Then we have depreciation for the year. Right. In the current year, they then used they produced 1.1 million newspapers. So say what do you get? $81889. Right. Then now we can test for impairment. Our carrying amount is equal to 428,667 minus 81889, which is equal to what? Thank you. 346778. Thank you, guys. Then we'll then determine our recoverable amount. Our fair value less cost to sell is equal to 180,000 minus 8,000. Remember that we told that the fair value of the asset was 180, but for them to sell it, they needed to incur legal fees of 8,000. So that would be 180 minus 8,000. What do we get? 172,000. Right. Then the value in use, we have to calculate it. We're not given this time around. So you have to use these cash flows and the discount factor of 9.5%. Right. Remember, we're in 2016. So 2017 will be after year one. So you can use your financial calculator. You can say cash flow one is equal to 80,000. Cash flow two is equal to 75,000. Cash flow three is equal to 60,000. I is equal to the pre-tax discount rate of the company. They will give you the pre-tax discount rate of the company is 9.5%. Then you find your PV, NPV. What do you get? Can you use your financial calculator? So there it is. 181,309. So if you use your financial calculator, you should get 181,309. Please make sure that you know how to use your financial calculator. Right, if you can see the fair value less cost of to sell is 172, and this one the value in use is 181. So therefore, recoverable amount is the higher value in use of 181,309. So we use the 181,309 as our value, our recoverable amount, as it is more than the the value in use story as it is more than the fair value, which is 172. Right. So if our carrying amount is like this, then our impairment loss is equal to our carrying amount minus the recoverable amount, which is equal to 346,778 minus 81,309. What do we get? 181, sorry, not 81. What do we get? Thank you. 165,469. Right. So we'll have our impairment loss during here, which is impairment loss is subtracted. Right. Then we get carrying amount at end of year. We have our costs, our accumulated depreciation, and impairments. Or let me just show the other way so that you can know how to do it also. And you can also put the accumulated impairment separately. So our cost would be the 920,000. Our accumulated depreciation would be your 491,333 plus 81,889. So that's another way. So as I said, you can combine them. Instead of having accumulated depreciation and accumulated impairment, you can just have one figure, accumulated depreciation and impairment, is what we did here. Or you can separate them. So I'm just showing you separately so that I can show you the other way. Right. Then we get our carrying amount. So I want you to see that at the end of the day, if there is impairment, your carrying amount will be equal to your recoverable amount. 181,309, you see here, our carrying amount at the end of the day. Even on the first question, if you saw our recoverable amount was 1.2 here, so our carrying amount at the end of the year will be 1.2. So as long as there is impairment, at the end of the day, your carrying amount will be equal to the recoverable amount. Any questions? Right, so at your own time, I want you to do the deferred tax note. The deferred tax, you first have to calculate your deferred tax. We have the carrying amount, this one, then you calculate the tax base using what SAS is granting here. They said SA normal tax, they give 40% in the first year and 20% a year, every other year thereafter. So SAS does not take into account the residual value, number one. Number two, SAS does not take the impairment into account. So you just calculate your tax base using those laws that are there at the bottom, the 40-20-20-20, but don't take the residual value into account and don't take the impairment into account. Then the deferred tax will be the you apply your tax rate to the difference between the carrying amount and the tax base, like what we did in I think on Saturday. Then you can also do the note for the impairment loss. You just have to change the amount and the reason. It's exactly like this one. What will only change is the amount here. You will now be using the new amount, the 165,469, and the reason why will be taken from the question. Any questions? Right. So impairment loss, my friends, it is a topic that is done within other topics. So we'll continue doing it. So don't worry, even reversal of impairment, we're going to do it through other topics. You'll see that when we do intangible assets on Tuesday, when we do the non-current assets for sale during the weekend, we'll be applying the impairment along the way. If you don't have any questions, then you can as well rest. Thank you so much, and God bless you richly.